afternoon, everyone. Welcome to Fintech Lending and the Role of Alternative Information. My name is Sam Taussig. I'm Head of Policy and Community Banking at Kabbage with a K, the small business fintech lender. So today we have two great panelists, one from Kabbage, one from the San Francisco Fed. I promise I'll be as neutral as possible. But we're going to dive into some of the questions that you all are most interested in with respect to AI and alternative data. CFPB, of course, issued a request for information on this a number of months ago, and the debate has been a hot topic in Washington and the bank centers around the United States. This is going to be an interactive discussion panel with our two panelists here going back and forth, and we'll reserve about 10 minutes at the end for Q&A, so think of some good ones. To my right is Tracy Basinger from the San Francisco Fed. Tracy, I'll let you introduce yourself, but give us an idea of what the Fed has been up to and interested in with this topic.
Great. Thanks, Sam. And I must say, as a regulator, it is interesting to be sitting here on a panel between two from the industry. So we did have a conversation about how this won't be Stump the Regulator. So anyway, my name is Tracy Basinger. I am the head of supervision at the San Francisco Fed. It's a new position for me. It's only been a couple months. And my life prior to that, I spent better part of the last 3 years pretty engaged, almost exclusively engaged in fintech. So I thought I'd give you just a little bit of an overview of what that looks like. I think today is a good example of what it looks like. The work that the Philadelphia Fed is doing here and having this conference is a great example of how the Fed is. There's a lot of really interesting grassroots work going on at a number of the reserve banks around the system, and then we're trying to coordinate that, at least from a supervision standpoint, to bring together folks across the system that are working on fintech and help develop views as it relates to our supervisory responses. And I've been lucky enough to be involved in that, as well as be involved in some work on the Basel Committee's Task Force on Financial Technology. But as it relates directly to San Francisco, we've been doing a lot of similar work that Philadelphia has in terms of studying the market, helping sort of with internal awareness, helping to support our supervisors in San Francisco and more broadly across the system. We also recently formed a fintech team early 2016 where we hired a couple analysts to focus exclusively on fintech, and they've been really helping sort of advance the message in our reserve bank. And then most recently, we have sort of taken more of an external focus on that work, and we, as part of our public web page, we launched a fintech portal where we provide, we call it Navigate, we provide resources that help industry stakeholders navigate, if you will, the regulatory system, what the regulatory requirements are, where they can go for help, where resources might be, and also try to provide relevant, timely information about what's happening in the industry. A part of that is an opportunity for fintech firms or any other interested stakeholder to reach out to us and meet with us. And we launched that in May, and actually have been a little surprised that we've had sort of over 30 organizations, both domestic and internationally, reach out to us, and we've hosted a number of meetings. And that's been really helpful to add to sort of the market monitoring and research that we've done, as well as sort of help us help these firms navigate the system. A big, as we'll get into a little later, a number of the firms that have reached out to us over the last few months are very interested in data. I would say probably more on the data aggregation side of it than necessarily the role of alternative data, but I think they're both very interrelated. So we've been happy to bring that perspective to sort of the system as we think through these issues. So,
excellent. Spencer, can you tell the audience how you ended up in fintech and what Kabbage does in the U.S. and abroad?
Sure. So first off, thank you all for having us. We appreciate the opportunity here to talk about all the great work that we're doing at Kabbage. So yeah, I have a technology background primarily. So I came to Kabbage about 7 years ago, and me with a couple of other guys at that point built what has grown into the Kabbage platform as it exists today. And over the years at Kabbage, performed a number of roles there where now I run strategy for really driving what we're trying to do today, as well as the expansions of what we're trying to move on to into the future. So as Sam mentioned, we've got two relatively parallel business lines, one being Kabbage.com, which is where here in the U.S. we do lend directly to small businesses through our unique understanding and usage of some differing data sources and our ability to understand and discern that down into a credit decision. The other side being our partnership business, both domestically and abroad, where we're really taking those same capabilities, both the aggregation of the data, both the understanding of the data, and what we believe is really a unique understanding of the customer experience that we're able to drive forward. And we're partnering with large financial institutions in order to help them achieve those same capabilities. We're live in multiple markets around the world today. We continue to grow that business, and it's something near and dear to our hearts. I think it echoes well after our previous talk here, where we agree that the partnering with financial institutions we think is a very important part of the growth of the fintech industry, and quite frankly, how we shed this alternative word from alternative lending and just get to the point where it's just lending.
Great, thank you. So Tracy, would you mind touching in general on some of the themes that you and your colleagues have discovered at the San Francisco Fed as it relates to alternative data? What data are we talking about? How's it being used, and how's it being deployed?
Sure. So I think I'd start by taking a little bit of a step back and just talk about sort of overall how we're thinking about fintech, and then how that translates into what we've seen in the data. So, to echo some of the comments that Bill made when he opened this, based on what we've learned, we have no doubt that fintech innovation can produce real benefits for consumers, and we recognize that it's all of us through convenings and meetings like this working together to actually help realize those benefits. And as we talk about what we're here to discuss with the data, the most interesting part of that is that it could expand access to credit and other financial services for consumers and businesses that are currently underserved. And while there is that promise, the challenge, as we see it, is to foster innovation that responsibly expands that access, as opposed to further calcifying existing inequities in financial services that exist today. And so I kind of want to stop right there and reinforce that. I think it's really important that we remember that we're coming to this discussion with the idea that we have underserved consumers now. We have some inequities in access to credit into financial services as it exists today. So that's the lens that we should be looking through. But having said that, it would be a real lost opportunity if instead of expanding access to credit, that some of these new techniques actually resulted in another way to market high-cost credit to consumers, or resulted in some form of digital redlining. So we do really need to be mindful of the impact here. So as I first mentioned, we are having a lot of meetings with numerous fintech lenders, data aggregators, bankers on a whole range of data issues, not just alternative data. And when it comes to alternative data, to be honest with you, when we read more about uses of it than we've actually been in conversations where we've seen or we've had firms be able to show us or talk specifically to true alternative uses of data. For example, things you hear about social media and whatnot. But I can run through what we have been seeing. So we have seen, or we have talked to firms who can explain to us how they're using new data or different ways of analyzing data in fraud detection. And that's in particular where we've seen people be able to talk to us specifically about how they're using things like social media and other types of data is in the fraud detection area. We've also had some great conversations with firms who can talk to us about how they're taking data off a existing credit report, and not just taking the FICO score, but taking the data and developing algorithms or other ways to analyze that data that they think is more predictive and gets them to better credit decisions and allows them to more granularly segment customers so that they can identify risk for both the credit decision and pricing better using data that way. We've also, through data aggregation techniques, had lenders talk to us about how they're able to extract income, cash flow, payments-related information, whether it's through a bank statement, your bank transactional data, whether it is through bookkeeping software for a business, that allows them to get better information on cash flows and on payment habits and whatnot, what some of the true debts of an individual might be, and their payment histories related to things like rent and utilities can be surmised from that. So we've had firms talk to us in that regard as well. And I would say, but outside of that, when you talk about items like educational data, which is the subject of the no action letter that Sam mentioned, or social media, we honestly have not spoken to many lenders at all that are able to show us how they're using that data. Having said that, our impression from the conversations we find ourselves in is that there's a lot of firms out there giving some serious thought to this and potentially testing it internally. And where we are in terms of it being brought to market in a broader way than we've certainly seen it today will be interesting to talk through in this conference.
Fascinating. We'd like to see some of that too. But let's dive into a specific example. So Spencer, you're the head of strategy, and so you're responsible for the underwriting and the risk there. Can you describe the alternative credit writing model at Kabbage, and how does the artificial intelligence and machine learning also play into this data and the underlying assumptions?
Sure. No, I think, Tracy, you brought up a lot of good points there. And I think we find when we talk to people and people come in to talk to us and ask these types of questions, I think there is a misconception of what this alternative data is. What are we actually doing? What are the new and fun things that are driving in there that we do? We go out and we talk about all of this that we do, but you strip all of the sexiness off of it. And quite frankly, we're doing the exact same thing that's been being done in lending for years and years and years. We might be using a different data source to get to that data, but we're trying to answer the exact same questions that any lender is always trying to answer about their accounts, whether it's a consumer, whether, for our case, in a small business. And it's a matter of trying to find what we believe to be the better sources of that information, and that as we start to look at being more open with those sources, what we can do is get closer and closer and closer back to the individual business or consumer themselves. And what we can do is strip away the delays in that data. And if we can strip away the delays and we can strip away other people's opinions of the data, then we can get closer back to that small business or back to that consumer. I talk with a lot of people about FICO scores in general. And we're actually, I think we're going to talk about it here in a minute, but one of the things I'd like to point out is that a FICO score is inherently disconnected from a customer. It doesn't make the FICO score poor. It doesn't say anything negative about it, but it is, as I would describe, a minimum of 6 degrees separated from that actual consumer's life. And that what a lot of these different data sources can allow you to do is start to strip away those degrees of separation and get back to the actual consumer, both in their spend behavior, in their historical behavior, and really be able to make a more accurate prediction of the future. And so yeah, what we end up with is a lot more data. We have a lot more data sources. We do need to do a lot more verification of those data sources. And that, I would say, is where a lot of the real sexiness of what we do comes into play, is how do we take these data sources that aren't necessarily initially intended for credit decisioning, and how do we cleanse them to a point where we're comfortable with using them for credit decisioning? Machine learning, artificial intelligence, all of these buzzwords that are out there are, quite frankly, just that. They're buzzwords. They're buzzwords for a new algorithm. Same way everybody's been doing it forever, it's just a new algorithm. Instead of linear regression, maybe we're using a random forest. And so it's not that it's an inherently different thing, it's a new algorithm for which to do it. And we would say the standards under which these algorithms are judged can be held to the same standards of these previous algorithms before. And so we see your experience a lot of people come in to talk to us, and it's almost like they're disappointed at the end of the day. They're like, oh, I really thought I was going to see some crazy thing where the time of day you log into Facebook, is how we drive the yes or no on your credit decision. And there's a lot of possibilities and a lot of data sources like that, and I think those types of questions and those types of advancements will continue to be something we all talk about and all look at. But at the end of the day, I would say that the alternative data that we're using is a different data source. It's truly that. It's an alternative data source to the traditional data sources that you're using today. And then one last note on the artificial intelligence and machine learning. There's a big difference between supervised learning and unsupervised learning. And a lot of times when people talk about and hear machine learning and these advanced analytic techniques, they jump to the unsupervised concept. The unsupervised concept being where the machine's going to learn on its own. The machine will continue to evolve and continue to develop and continue to refine its decisioning capabilities and refine its predictions in truly an unsupervised manner. What you're seeing across the fintech landscape is usages of supervised machine learning, meaning that we're sitting there in an offline environment with historical data pinned towards an outcome that has already happened and asking the machine to try to figure out how to best predict that outcome. And then much like we do in the large financial institutions today, we're looking at what it learned. We're looking at the attributes that it learned. We're looking at why it's making the various decisions. What are the impactful attributes there? And we're able to, at the end of the day, explain that model that gets kicked out, even out of these advanced algorithms. It's harder for me to write on paper the exact calculation that drove the prediction, but it's possible. It's just more advanced. Quite frankly, it's nonlinear instead of linear. And as we start to expand dimensionally, the computer can do it very easily. It is not as easy to write out on paper, but that doesn't mean it's not possible. And so I think that nuance between the unsupervised and the supervised is an important concept that I would ask everybody to take into account when they're looking at artificial intelligence or looking at machine learning in general.
So Tracy, I want to give you time to respond to those comments, but Spencer argues, one of the things he argues is that Kabbage is just looking at basically the small business objective data, the performance data. Do you see a difference with the consumer fintechs that you've talked with? Or is it just looking at the same traditional data in a different way or with a slightly different data source? Is there anything revolutionary?
In the consumer space?
Right.
I think the way Spencer described things, that it does translate fairly similarly, and I'll go back to the comments that I made, that for the most part, the firms that we've talked to and the information that's been shared with us, it is in fact using traditional credit-related data and using that differently, analyzing it differently, developing different algorithms, as opposed to, notwithstanding the fact that we have the CFPB no action letter, where we do have a firm out there that is considering educational data in the underwriting process. We're not seeing that widespread. So clearly there's opportunities to consider other types of data. There are some firms out there that are doing it, but on the whole, that's not been what we've seen, nor do we see firms sort of testing that on a widespread basis either.
Great. And Spencer, you hinted at FICO here. So maybe it's not on its way out the door, but if alternative data and new data sources, rather, are so useful, why are traditional financial institutions still very reliant on FICO? And Tracy, feel free to jump in on this too.
So the FICO score itself is still an extremely powerful directional indication of credit. And even if you talk to the people at FICO, what they'll tell you is the score is intentionally broad. And intentionally broad scores are only useful in broad applications. And so what you're seeing at not only the fintechs, but also inside of financial institutions themselves, the larger ones, is that attempt to get down to a more granular view and granular understanding. And it's those areas where something like a FICO score starts to fail. Again, it can give you directional indication, but you will be able to understand your specific pockets of populations better off of a broader set of information than just FICO. Doesn't ever mean you're going to throw it out the door. And I still look at a FICO score. And so it's still something that's going to be with us. I'll tell you, we do a lot of work with the people at FICO. They're brilliant people over there. It's not going away anytime soon. They'll continue to evolve with the rest of us. And I think they would say the same things of a FICO score is broad. If you want a granular understanding, then the FICO score is not that. If you want to know what 1 out of 1,000 consumers is going to do, FICO score is not that granular. If you want to know what 1 out of 1,000,000 consumers is going to do, FICO score is going to be able to tell you that.
I mean, I think he said it really well. The only thing I might add is that, as our analytical techniques evolve, that doesn't mean that that's a condemnation on the previous analytics that were in place, and I think we just need to remember that.
Yeah, I'll jump in there too and say from a machine learning perspective, we serve not only our Kabbage.com product, we also do a lot of the credit modeling for our international partners in specific. There are a number of instances where we are still using linear models in order to make our credit decisions. And, the advanced algorithms aren't always the answer. They sometimes are. And our position would just be that when they are that much better, then we should be willing to use them.
Sure. Spencer, I think a lot of people in the audience, especially the supervision folks, might be wondering how do you develop the models when you sit down with your counterpart at a foreign bank?
There's a lot of coin flipping. No, yeah, I mean it's very consultative. So from our perspective, when we're working with another financial institution, the main message we try to get across early in the process is that it's their product, that we are there to help them with their product, that we have a unique capability with the data. We've worked with these particular sets of data a lot in the past. We drive our own products off of these sets of data, so we have an understanding of how to work with them. But that at the end of the day, the credit boxes, the approval criterias are all coming from the financial institution themselves. So when our modeling teams develop a risk model for one of our partners, it goes through their full model approval processes. It's not always easy, quite frankly, it's usually a pain. But I think it's important to note that it's going through the same rigor that any credit model through that financial institution goes through. And, so we deal with the regulatory bodies in those foreign countries. And our goal is to look at the financial institution and say, you're going to have to stand by this credit model with your regulatory bodies. We're happy to stand there with you if you want us to. We will fully be willing to talk about what we did, how we did it, what's in there, what's not in there, et cetera, et cetera. But at the end of the day, it's theirs, and we want them to not need us to be there. So it's a full transparent process. We invite them in. We oftentimes have them sitting next to us while they're doing the model builds themselves. They're to a T. Every single one of them has done independent rebuilds of all of the models that we've built inside of their own environments as part of those validation processes. Many times we're bringing in third parties to do independent validations and verifications outside of the both of us as well. But I think if the people in this room were to sit and watch that process, I quite frankly think you would be upset at how boring and normal it is.
Great. So ABA opened the door, so let's play fortune teller ourselves. Tracy, what can new data sources and artificial intelligence do for the financial services industry, let's say over 10 years, and what might be some of those limitations?
Okay, so as we talk about data in particular, alternative data in particular, and data usages overall, I'll take a bit of a step back here, and then we can get into some specifics around the potential issues that it presents. But data and access to large and wide-ranging sets of data, it presents a broader consideration that gets to providing consumers better ability to manage their financial lives, tools for consumers to easily use their own data to improve planning and budgeting. And for providers, it also provides the ability to provide products and services that are more tailored to consumers' needs, and the ability to extend credit to those who might not otherwise qualify or at lower price than they might otherwise qualify. So as we think about how the data is used, to me, I think there's two important policy issues that are relevant for the discussion. One is data aggregation, and the other is the alternative data that we're talking about today. And as Spencer mentioned, the CFPB actually has done requests for information on both of these issues. The data aggregation was November of last year, and then the alternative data in February of 2017. And then, of course, we have the recent no action letter on the use of alternative data, specifically educational data, to underwrite and price loans. So as we think about data and how it's used, it's generated a lot of excitement and concern, and it's a significant topic, not just in financial services right now and not just for fintech firms. There's just a lot of interest and discussion generally about the potential positive uses of data coupled with machine learning and AI to help businesses better serve consumers and, in fact, to help policymakers solve broader social problems. But there have been some concerns raised about issues such as fairness, security, and privacy that have been mentioned. And so as we think about this from a policy standpoint, I think so much depends on exactly what data we're talking about and how the data is used. And it's important that when we think about this, we don't view data or any of its usages of new data sets as sort of monolithically bad or good. But it's important to remember that, the fact that an algorithm is data-driven doesn't necessarily ensure that it's fair or that it's objective. So I'll throw out a few questions that are things that I know, at least inside the Fed, we've been thinking about or having some conversation about as we look at new uses of data or new uses of technologies to analyze data. The first one is, what is the basis for using certain data? And one example might be if a particular set of data or data fields prove predictive in fraud, that doesn't necessarily mean they translate into other uses. So how do you think about identifying what the basis for using the data that you're using for the reason that you're using it? When we look at the credit decisioning process, is there a nexus to creditworthiness? I think that's what we've been talking about now so far today, is most of the data that we've seen used really does have a nexus to the kind of data that's currently used to determine creditworthiness. On the other hand, data that doesn't lack an obvious nexus to creditworthiness, we should probably look at that a little differently and ensure that it's not a proxy or signal that could result in some unintended consequences. When I normally transition in this part of the talk, I would say, for example, we understand some lenders are considering where an applicant went to school or their level of education, and that these fields require additional scrutiny as they could raise fair lending considerations. I think that's still relevant, and I think the fact that there's a no action letter out there from the CFPB, it's a form of acknowledgement that with this additional scrutiny and analysis, the data can possibly be used to responsibly expand access to credit or to provide less expensive credit. But having said that, I think we need to be diligent to ensure that the usages don't further entrench any of the existing inequities in the access to financial services. The next area we talk a lot about is the data transparent and accurate. We think about how the data, if it doesn't have a nexus to creditworthiness necessarily, do consumers know what kind of data is being considered and how it impacts their ability to obtain credit? Do they understand what kinds of behaviors contribute to or detract from their creditworthiness so that they have the ability to address any weaknesses in their credit record? Are consumers able to review this data for accuracy, and then is there a mechanism for them to have it corrected if it proves to be inaccurate? And then along those lines, we're thinking through things like, is the predictive potential of the data likely to be stable over time? And are the data accurate and representative for large sets of consumers? As we think about using non-credit related data, the question is it going to be reliable over time? For example, if a model uses data from social media or Yelp such as Yelp or Facebook, what happens to the reliability of that data as consumers' online habits change over time, and how is something like that factored into the way the data is used? And I think one of the compelling pieces of information in the application form for the no action letter that the CFPB issued was several statements that this educational data was not used in and of itself as specific data points in the algorithm, but it was the way that data interrelated with other credit-related data. And so it's understanding how these data, their reliability and how they're used over time. And then the last one I would raise is something that Sam touched on, and that is, are the results explainable? And we fully understand that as you move into uses of machine learning and AI, it can be difficult to explain the results, but I think at the end of the day, as Sam mentioned, it's imperative, Spencer mentioned, it's imperative that we are able to. We have found ourselves in many conversations with firms who are experimenting with different uses, and the answer is, well, we don't know exactly why the algorithm made the decision that it did, but there's a tendency to want to rely on it nonetheless. And I can tell you from a regulator's standpoint, that's probably not a conversation that I want to get into with one of our bankers. That's typically not going to go particularly well. I think we really have to be able to explain the results, or that we're not going to make the progress here. So, I mean, I guess I'll just wrap this up by saying I'm not trying to be negative in any way about the data. I think there's lots of great possibilities here. We just need to make sure that we're fully understanding the impact of of how these new data operate, and that regulators and providers of these services are engaging in the process, and that the results don't exacerbate any of the inequities that exist today. And then having said that, I would argue that the fact that there are concerns about fair lending, potential UDAP or other issues, shouldn't be a reason not to continue testing and not to continue experimenting, because the upside potential here, I think, is too great when we're looking at expanding access to credit in this country.
So Tracy, I want to give Spencer a moment to comment on everything you said. Before we do that, I mean, you touched on a number of sticky policy areas that we'll absolutely see over the next couple of years with FinTech: fair lending, disparate impact, the proper usage of data, and the underlying assumptions. So those are real policy questions that have significant enforcement and supervision outcomes possibly associated with them. What kind of quantitative work has the Fed looked at or is beginning to look at to actually analyze this and quantify the impact across the financial services environment?
Are you asking if we're testing certain data usages?
I am.
Yeah, I would, I would think of that in the context is that each data is not going to be universally predictive or not predictive. I think as you look at any one algorithm, it's a sum total of the data that's going to result in sort of what's appropriate for that particular use case. So I don't think you can test them outside of individual particular use cases. But in the supervisory side, it's our work at that certainly isn't to the point where we are today, nor would I envision us necessarily analyzing individual. I can't envision a scenario where we would say, yes, this data is good, nor that, because it would not be. It wouldn't be appropriate. That wouldn't. It's similar to the way credit is analyzed today. It's very specific to the individual entity and the decisions that they're trying to make.
Okay, fair enough. So Spencer, as a technologist and a model practitioner in the space, what do you think about these issues? How do you see them developing over the next couple of years? I mean, what floats to the top of your mind and keeps you up at night?
No, I mean, I think it's over the next few years, up to 10 years, I think what, first off, I think the access to data and just the general acceptance of other data sources is going to be something that we all grow to just accept. I think if you look at the recent 10 years, and if you look just farther back in history as well, these sorts of rolling tides are not something that we stop. These are things that we either figure out a way to get on top of or we get rolled over. And so I think that the usage of data, I would agree with what Tracy mentioned here, of the fact that there's questions about it doesn't, I think, change what we look at and see out of the potential of it. And, that if we do find certain areas of concern or certain bad actors in the field, does not change the capability and the power that is there when we start to expand the view of the data and we start to be open to these different sources. A lot of the questions that you mentioned you guys are thinking about there, I love them. Quite frankly, I would word every single one of them slightly differently, but those are exactly the types of questions and processes that we go through when we're developing models. It starts very much at the applicability of the data towards the outcome you're trying to predict. It goes back to the idea of, I don't care if the time you log into Facebook happens to correlate to the outcome of a credit action. It's the difference between correlation and causation. And what we're after here is finding the causal relationships. Correlative relationships are dangerous. They're just that. And you see that in every field that makes use of this sort of data to start to drive towards potential actions and potential predictions. And so I think what we'll find is that in the field of data science, and when you're working with professional data scientists and professional statisticians and data people, the types of scrutiny you want to hold them to are the level of scrutiny they're already holding themselves to. And this is where I say I would word them slightly different. I think we got to do things a tad bit different, but the philosophy of what's trying to be done is already there. And so it's a matter of, if we look at philosophically what you're worried about and what you're trying to get to, those are the same questions and same things that myself and my modeling teams are kicking around ourselves. Every time we find a new source of data where we're finding correlations to credit decisions, you can't just throw it out there. There are stability questions. There are, you look at something like a social media. It's still a relatively new thing. Yes, the data is interesting. Yes, I could talk for hours about all the fascinating information inside of social media as could be applicable towards credit decisions. But we do have to come back and look at the question of, but has the usage of social media by the population been stable long enough that we would say, just because there's a correlation there today, do we think they'll continue to use it in the same fashion such that that correlation will be there in the future? And so that I think is what will continue to evolve over the next few years, is where right now I think we're wondering and we're worrying and we're working with various parties to try to prove that there is enough stability in these various data sets that we can get past these questions. We got past these questions with everything that's in a consumer credit report a long time ago. Before that, there were all the same questions about those data sources. So it's possible to move past it, and I think you'll see us do that in the next few years as an industry. I think I've seen enough interest and desire from every group that we talk to understand that there's at least a need to try. And that if we try, then we can have the conversations, and you've got the me's of the world that is going to be able to convince you.
Spencer, you touched on the importance for data scientists to check the underlying assumptions. What have you done to do that?
So we do a number of things internally. We have our own, we have our processes and procedures that we hold ourselves to very diligently. From start to finish, we have our own internal validation teams separate from our modeling teams that work on any new prediction that we're making or any new risk strategy that we make. But we've also begun to engage with outside third parties for independent verifications. We think that's important. 5 years ago, if you would have asked me to talk with anybody about any of the details of what was inside our credit decisioning, I'd be like, no, that's completely mine. I'm not talking to you about it. And I think where we've evolved as a company, and where I think the industry has evolved, is it's okay to talk about it, and there's certain scenarios where I need to share that with people. And so particularly in these sort of external validation concepts, we've worked directly with firms where we've given them all of the data we use to build the models, all of the attribution that we create, all of the history that we're validating it off of, and had a completely external party try to rebuild both what we did, try to build through more traditional mechanisms to see if they can beat and outperform what we've built. We've been able to significantly outperform all the industry standard benchmarks there, and receives multiple stamps of approval from these external parties on our methodologies, our capabilities, our usage of data, our usage of attributes, and we find all of these things to be extremely important. That we've always tried to be a company that, we've tried to be a company that operates on what we should do, not what we have to do. And we think this is one of those areas that right now it's still a should do. And we're working with the various parties to translate what needs to change from a should to a have to change those appropriate things to.
Excellent. It's great to see the public and private sectors working together on these sticky policy issues. We have about 10 minutes. Let's open it up to some audience questions. Do I see a hand? Yes, sir.
For Tracy, the various regulatory agencies, are you all taking the same approach to the fintech space, or how are you gaining consistency or consensus kind of behind the scenes?
Yeah, so we're certainly all talking to each other. A big part of what we're doing at the Fed and the other agencies is making sure that we're having conversations. Data is one of those key conversations where the CFPB has their issues. and authorities related to data aggregation and alternative data, and there's implications as it relates to security and whatnot for the prudential regulator. So lots of discussion and coordination going on that way. Everybody's approaching it slightly differently, but we're certainly at many levels across the country having discussions, and also talking with our colleagues internationally as well, learning from what's being tried in other parts of the world and how they're responding.
And then I think we have a speaker tomorrow, OCC. It seems like they're the ones that have kind of put the stake in the ground if you want a fintech charter. Is that correct?
I'll let them speak to that. Yes, they do have a proposal out there. There's other regulators that are thinking about sort of their approach to fintech as well, and how it relates to that.
And I'll say, as the policy person at Kabbage, we're open to all of the options for fintech. Kabbage, we're personally very interested in the OCC charter. And we've had some great discussions with members of their innovation office there to talk about the specifics. It's obviously still coming along, and we're excited to be part of that process. The other options, an ILC, for example, the Conference of State Bank Supervisors are working on a Vision 2020 multi-state licensing plan. So there's a lot of interesting policy discussions out there that are incorporating the kind of subtopics that we spoke about on this panel. But it really kind of needs a much larger dialogue in Washington, and we'd like to see more companies and more of civil society get involved in a constructive way. But we'll take another question. Yes, ma'am.
So you mentioned, and this is really picking up exactly on what you were just talking about, in terms of the different models for the regulatory construction, but currently we're not there. And it seems Kabbage, of course, as you said, has two strains. One is more of an in-house consulting. You can think of it as white label, but another is a direct lending. So how are you doing it now? And I'd like to get an idea of whether or not you're using traditional banks in order to make the loans, and what do regulators like the San Francisco Fed think of that, and how does that deal with state usury laws in terms of interest rates? That's a lot, but.
Those are a lot of questions. Sure. So Kabbage is a semi-direct lender in the United States, if you will. We use a Utah ILC partner bank to actually help us originate the loans. The marketing people at Kabbage hate when I say this, but we're really more of a tech fin than a fintech company. We have a lot more technologists, data scientists like Spencer than we do former bankers or even non-tech folks like myself. We are not a bank. We don't have a bank culture. We don't have a bank mission. Our mission is to look at the data and look and use technology to help make credit underwriting decisions with those banks. So in the U.S., we have an exclusive partnership with Celtic Bank. They help originate, and we're able to lend with them through all 50 states, and it is based out of Utah, and so specific to your usury law, we're using Utah state standards there. Yes.
Hi, yeah, I'm just curious to hear kind of thoughts around thin credit individuals, or in general, like the data points within that. I think I had heard a stat recently that the CFPB had said about 40% of individuals are either thin or subprime, kind of unscorable or subprime. And I'm just curious, like the data points that you guys are looking at from a Kabbage perspective, Tracy, also to hear your points, just in terms of building out what the new data points we can to kind of look at that subsection of folks.
Sure. Spencer, you want to take a stab at the thin and underbanked population?
Sure. By definition, when we expand the data sources, then we're expanding the set of people which are going to have enough data to be able to be decisioned through those types of processes. And, so it's definitely part of the story there. I think from our perspective, we would say that, again, as we start to remove the degrees of separation from the entity on the other side, then we're able to make a much more granular decision about that individual business or individual consumer, and that granularity is another allowance of an expansion of that credit box, is that there's a precision there that allows you to lend to a different population than you're lending to today, because you've got a more precise prediction on the behaviors of that entity at the end of the day. Your question is really specific for consumer thin files and such, which we obviously don't do consumer lending ourselves. So I can't speak too much to too many specific statistics there. Other than to say, again, our original mission, we started in the e-commerce space, and from a small business perspective, the people we wanted to serve were the people that don't show up in commercial credit reports, the people that don't show up in any of your traditional commercial bureaus. And so whether they deserved credit or not, they were not going to be able to get it from traditional institutions because from their perspective, they weren't a traditional business. And that it's the access to the data that allows you to look at people different from that.
And then from a regulatory standpoint, I would say, we're certainly not going to be modeling or making the credit decisions, but it's really important as regulators that we continue to meet with entities that understand what data is being used, how it's being used, what the algorithms are telling you, so that we understand as a regulator what are the kinds of actions that we take that can help facilitate the good outcomes, or what are the kinds of things we want to avoid doing because they would prevent or otherwise inhibit those good outcomes. And then on the other side, what are the areas where we feel like maybe that's getting outside of a policy area where we would be comfortable. So our role would be to engage and to understand and try to help us make good decisions about where to put the regulatory guardrails.
From a policy perspective, we are FDIC examined through our bank partner, but we also interact with the Federal Trade Commission and CFPB, of course. And kind of through those original prudential channels, we've actually developed a really interesting policy conversation on this, partially because we are commercial only. We feel a little bit more in the policy context to talk about the possibilities in consumer thin file underwriting, but it really is an ongoing conversation. I think I would challenge some of the research institutions and academics in the room to work with industry and work with federal partners to actually look at this in a much more quantitative way. There's not a whole lot of great hard data on it right now. I think we have time for one more question. Yes, sir, in the blue.
Looking at this from a worldwide perspective, and there seems to be a policy, there's a different approach to policy, both in the U.S. and the rest of the world. For example, in England, you got Financial Conduct Authority, Singapore, MAS. They seem to be writing bespoke regulation to handle the fintech sector, but the U.S. seems to be more shoehorning this into existing frameworks. Even Reg CF is pretty much using what you know about equity crowdfunding from equity issues, normal equity issues. Is there any plan for changes? I mean, or do you think the existing framework is the right way to go?
Yeah, so I think it's an interesting observation. We certainly we spend a lot of time, all of the domestic regulators, understanding what's happening in the UK and Singapore and other parts of the world, and understanding why they've adopted the policies and the postures they have, what's different about their regulatory infrastructure, what's different about their financial services landscape, how that does or doesn't translate into the US. So I think there are some real differences between the markets, the number of institutions, the role of the regulator in some of those markets, but we're certainly trying to learn from their approach what is and isn't working and what about that would translate into the U.S., which has a much larger and a much more complicated financial services landscape and regulatory landscape.
We'll do one more. The gentleman in the blue with a quick hand with
Cool.
the mic. Yeah.
This question is for you, Tracy. I wrote this down. I'll just read it. Tracy, you mentioned there's a risk of alternative information, such as school attended becoming proxies or running parallel to discriminatory lending practices, which I appreciated. I was wondering, what sort of protections do people have from the use of these proxy indicators being used as a layer of plausible deniability for making discriminatory lending practices based on old assumptions and prejudice?
So I think the answer to that question is that there are a host of consumer protection laws that apply to anybody that extends credit in the U.S., whether you're a bank or not. And those fair lending, anti-discrimination, some of the UDAP laws certainly would apply in this situation. So there's nothing that says this data is okay to use and that data is not. But as we look at educational data or any other data that we haven't historically seen utilized, and quite honestly, even data we have seen utilized in the past but used in different ways, we're asking ourselves, the questions around how did you ensure its predictability? What are the consequences of this particular algorithm? Are you certain that it's not having any unintended consequences? And those particular rules would be the ones that would provide some sort of remedy if there were unintended consequences.
I'll add a little bit to that. I think it's also one of the reasons that it's, if I understand your question correctly, I think it's really important to understand the source of the data and what actually generated that data. And that it's not always just looking at the specific data element you're using, but understanding what is it that actually allowed that data to have the value that it has today, and ensuring that there, to your point, is not an unintended driver to the fact that you went to a specific school that you may not have wanted to be in your actual credit decision.
Fantastic question. I'm really looking forward to the rest of the afternoon. I know that you two have to get to the airport, but Tracy, Spencer, thank you so much for telling us about your work today.
Thank you all.